inverted yield curve has always signaled a recession. But what happens when the inverted yield curve decides to disappear? Today, we're going to find out what happens to our economy, whether a recession's on the horizon or not. So we all know the Federal Reserve is extremely responsible for how the economy reacts. But how exactly is the Federal Reserve's actions influencing the market? Well, when the Fed cuts rates, borrowing becomes extremely cheap. That means banks can lend more money, which increases the money supply in the economy. And to make it as simple as possible, if you just look at this chart, it's color-coded with easy graphics for anyone to understand. The Fed cuts rates, borrowing costs go down, and then buyers jump in. And what happens when buyers jump in? Demand goes up, and then prices go up. Rates are always fluctuating. And of course, it's the complete opposite when rates are rising rather than being cut. More money in circulation typically leads to more inflation because there's more demands chasing the same goods, which of course we all know would drive up prices. Now, when inflation rises too fast, investors demand high long-term interest rates to compensate for the amount of risk. So what happens when there's a reversal in the yield curve? And what does this mean for you and your portfolio? So if you don't know, what the inverted yield curve is basically when short-term interest rates were higher than long-term rates. And to put that into perspective, let's say that there's a bank and the bank wants to lend money out to a person, and this person wants to take a short-term interest rate. Now, the bank is giving you secondhand interest rates because the interest rate that they got from the Federal Reserve is vastly different from the interest rate that you're going to get. And if you pay attention to what they're lending, then you could see where their trust is. For instance, if they're raising their short-term interest rates, they think that there's probably a higher chance that you're going to default. So they're going to try and take as much money as they could possibly get in upfront and sooner. Now, with long-term rates, of course, they have a much longer time horizon, so they're able to charge a little bit more because it's extended for a longer period of time, which inevitably will allow them to get the amount of profit that they're looking to get on the money that they're loaning. And studying these two different things and when they're flip-flopping has indicated in the past recessions. Now, when everyone was talking about the inverted yield curve, that was saying short-term rates were higher than long-term rates. But how has that always predated a recession? Well, that inversion that everyone was talking about has actually disappeared. And here's the weird part. It disappeared while Fed was cutting rates. Now, let's break down why this is happening and how it could directly impact the landscaping of how you invest moving forward. Like I said, historically, the inverted yield curve has always meant trouble. In fact, it's actually predated every single recession in the US since 1955. But since September 2024, long-term interest rates have been rising, even as the Federal Reserve started cutting short-term rates. That seems counterintuitive, right? The Fed is lowering rates while long-term rates are going up. Here's the thing, the Fed controls the short-term rates, but the long-term rates are largely influenced by inflation, expectations, and overall money supply. Now, since September 2024, long-term rates have been climbing, even as the Fed was cutting short-term rates. Now, why? Because inflation fears are growing, and investors are demanding higher returns for locking in their money over a long period of time, as I stated earlier. Let's look at the money supply data and note its massive uptick in 2020. And now look at the money supply data from the last year. It's been increasing, and not insignificantly, which means more dollars are chasing the same goods, driving prices up. That is why long-term rates like the 10-year and the 30-year treasury yields have surged from under 2% to around 5%. The results? The yield curve has uninverted through what's called a bear steepener. Short-term rates dropped slightly, but long-term rates shot up. Now, this has a massive impact on investments and borrowing costs. So when long-term rates shoot up, what does this mean for your investments? For starters, long-term bond prices have taken a massive hit. Bond prices and yield move in opposite direction. So as long-term yields rise, bond prices fall. If you've been holding long-term treasuries, you've probably noticed some losses. Second, borrowing costs like mortgage rates have climbed, making real estate and other debt-dependent assets less and less attractive. For instance, if you're in the car market, which I'm a big enthusiast of, all of these cars are depreciating extremely fast, even the collector ones. There's no longer any long-term benefit in even the car market right now. But it's not all bad news. Short-term treasuries and high-yield savings accounts are offering safer, higher returns than before. So how do we position for what's next? Well, the bottom line, if rates keep rising, long-term treasuries remain risky. So what should you do? Focus on shorter-term duration investments or assets that benefit from inflation. And keep in mind the key phrase here, benefit from inflation. For instance, if you look at gold, gold has been breaking new all-time highs. And in fact, it just broke a new all-time high once again passing over the $2,800 mark. So with all this madness in the market, if you've been watching this channel, you know I've been leveraging software to help my portfolio be active in bullish or bearish scenarios. And it's the most market neutral strategy that I've implemented into my investing. And if you haven't seen any of the videos of how it's been performing, just click some of these videos here and you could actually track the entire thing with me and you could see how well it's done during all of this time. If you like this video, please leave me a like, comment, and or subscribe. And like always, my friends, peace.